Hey everyone, Paul here, and I want to talk to you about a company that I think has the potential to 10x over the next 10 years. And when we look at it, I want to cover the insider buying trends, take a look at the annual financials, the quarterly results. We can get into 2020 in more detail. A pretty interesting Q&A with the chairman of the board, as well as the valuation, and then just kind of generally talking about some trends in the share price and some different business strategy updates from their investor presentation. So, with that in mind, let's get into the analysis. By the way, I want to be really clear when I talk about that this has the potential to 10x over the next decade or get there by 2030. That comes with a lot of risk. So most stocks that I'm going to be investing in, they're going to be relatively safe. They're going to be things that have good cash flow, things like that. But I want to start getting into a little bit more where there's some good upside. But again, just really want to be clear that this is definitely, it's a micro cap, it's a high risk stock, but the payoff could be equally as high. So first of all, let's take a look at the insider activity for FlexShopper, FPAY for the symbol here. And when we look at it in the past 12 months, there have been 57 open market buys, 2 sells with a total of 59 trades. And, we go down and we look at the number of shares that are being traded, and the purchased shares are over 1.5 million compared to just 88,000 sold. So the net activity shows that 1.475 million in purchased shares. And some notable shareholders here. So the chairman of the board has been a really big supporter of this stock. He holds over 2.6 million shares of this, valued at over $7 million. We also look at Scott King and Richard House Jr. Richard House Jr. being the CEO, Scott King being a director, but these guys still own, over 100,000 shares as well. So again, always good to see, insider buying activity, seeing that, insiders are adding to their shares in the last year more so than they are selling. Let's first take a look at the annual sales and the year-over-year change. So this is a stock that has really been growing overall. We look at that about $48 million in revenue in 2016. And, most recently for the trailing 12 months, they're up over 96 million. So they have been seeing good growth. There was a little hiccup here. They had, lost 8% year over year for sales, but they got back on track in 2019. And again, back on track in the trailing 12 months. Another thing to keep in mind is that their gross margin is overall not as good as you kind of would hope to see, and that's something I think that as they continue to optimize their customer acquisition costs and work to beef up their business to business sales strategy, I think that again there's the potential for that to increase, but that's one of the knocks on this stock and one of the reasons why it's a little cheaper for where it's trading at today. And then we take a look at the quarterly data. So I've got it from March 2019 to September 2020, the most recent quarter. And when we look at it, I wanted to take a look at the year-over-year change. So for March, June, and September, that year-over-year sales increase was by 9%, 18%, and 7% in that order. So they have been seeing good responses in terms of revenue, with the pandemic kind of being a tailwind for FlexShopper. So FlexShopper being an online entity, and of course with 2020, a lot more people have been conducting business online, and that's going to be to some extent, I think, a trend that is going to continue, which again is going to be a net positive for FlexShopper. I wanted to bring this into it as well. So this is an interview, a Q&A with the chairman of the board, that individual that was buying a lot of the stock, and a major shareholder of FlexShopper. But I especially thought that this was, the last couple questions here, right? So talking about that, when he brought in the new CEO, says, hey, what skill set does he bring to the table with this? And he says, Rich is a risk expert, maybe one of the best. It takes an entirely different skill set to run an enterprise of 100 million in revenue to 500 million or maybe even a billion. We expect significant growth in the future of this company. And then he said, is there anything else you'd like to add? He says, grab a box of popcorn and watch how this plays out. This should be a fun one. Very excited for the future. I'm not involved in this for sport. My focus is very clear. So when I see somebody who's holding as many shares as what he's had and how he's added to his shares in the past 12 months, and I hear that language, I get pretty excited, and that's one of the reasons why, again, I think that this could actually be a 10x if all the stars align, if a lot of things go well for this. But I think that this could be a home run. Again, high risk, but high upside. Now let's take a look at the valuation for this. So the share price most recently closed at $2.81. The market cap is only $60 million. So this really is a micro cap stock. I mean, that's really just super, super small, especially when you consider it, from, companies like an Apple or an Amazon that are over $1 trillion in value. So when we look at it, though, we take a look and we say that the forecasted sales for 2021 are about 100 million. And if we assume an 8% growth rate, where they can get about $200 million in sales by 2030, then we can kind of go down and we can assume or take a look at what we think that investors are going to pay for those sales. Now, for this company, I'm going to start out saying that, hey, what if investors paid 2x sales, which right now they're actually paying one or less than 1x sales, right? Which reflects a little bit of that risk. But if they are still a growing enterprise by 2030, I think that, at that point, I think investors will start putting a premium on the sales instead of kind of trading less than 1x, okay? So we have those assumptions, and what we do, we can take a look at what would happen if they had the same share count, or what if they were diluted by 50%. So with the first pass, if they were going to be paying twice the revenue, with the current shares outstanding, so if they really didn't issue any more shares, by 2030, they'd be worth about $19.49 with these assumptions. That would be about a 24% annualized return, and then discounted back, that would bring them to about an $8 valuation. Okay, but again, that assumes no dilution, and they have had share dilution, and there's a combination of stock options awarded to incentivize, as well as just needing the capital because they're still kind of transitioning to profitability. So, well, what if they do dilute their shares by 50%? We take a look at that and we can say, okay, well, at that point, they'd still be worth $13 by 2030. You're still growing at about an 18% annualized clip in terms of your investment dollars in that scenario. And then bringing that back to today's dollars, your present value would be about $5.50, which again compares really favorably with that $2.81. And that's all with these inputs here, right? And again, that's with them being at 200 million in sales. I mean, we could talk about, well, what if they grew by 10% a year instead? What if there was a 3x multiple on the sales? Because again, if this is a company that's going to be thriving in 2030, I think at that point investors will start to place a premium on this. Well, then all of a sudden you could easily say that, hey, they could be up over $30 a share, or even in present value, that would bring their value up over $10. Even on a fully diluted, it'd bring them at about $10. So some different scenarios to look at there. So really, I think the main takeaway with the valuation here is, I think if this company can survive and they're going to be successful in the next 10 years, I think that if they can do that, I think that there's a lot of value here. And obviously if they don't, it might be worth zero. So this is something, it can 10x or it can go to zero. Okay, so it's really important to understand those risks when you're investing in companies like this. Let's also take a look at what FlexShopper does. So FlexShopper is a leader in the virtual lease to own, or LTO space. Now, historically speaking, as with a lot of stores, the primary way of doing business with lease to own has been with a physical location, but with the emergence of e-commerce, there's been the new opportunity to move that online. And when we look at the total market, it's actually estimated based on Wall Street research to be about $25 billion. And again, the fact that they're currently only around 100 million in sales, they've certainly got a long runway for growth if they're able to capture a bigger chunk of this market. So about 50 million Americans are considered to be underbanked or subprime, right? So a lot of customers out there potentially needing the ability to utilize FlexShopper's technology as far as underwriting and things of that nature. And another benefit or kind of thing that FlexShopper is trying to leverage is working with their business to business partners, saying, hey, if you have a customer that doesn't qualify for your standard credit assignments, put them on our lease to own, method or financing, and we're going to help you save the sale. So you're not going to be losing that customer. We're going to be able to pick up that customer in terms of they're going to be financing that with FlexShopper. So it's kind of a win-win for both of them. So they're expanding those pipelines. Here we can take a look at the breakdown from their B2B channel compared to their B2C, and we see that about 60% of their business is actually coming from their business to consumer channel, so going direct to consumer. 35% of that is then going to the business to business. And the business to business, again, the main selling point there is that they can say, hey, you're going to save the sale by working with FlexShopper, because again, if they're working with a customer that doesn't qualify, can't make the purchase, doesn't qualify for credit with the store, FlexShopper would be able to come in and potentially help them save that sale. And again, I think that the business to consumer channel is something that is going to continue to benefit from the move to more e-commerce sales. When we look at the past 5 years, FlexShopper is actually down over 50%. They've lost a lot of value there, but they've been doing a lot better, in the last year. So in the last year, they're actually up 22%. And we can just jump back, again to this 5-year view. Something to kind of keep in mind when we look at this zoomed out perspective is that, really from where they fell off a cliff, which was when in 2018, we remember that they had that 8% drop in revenue, which, the market obviously did not respond favorably to. But when it kind of bottomed out here, from this time to where it ran up in February before the onset of the coronavirus, the stock was up 335%, and it rallied up to about $3 a share. But then after the virus sell-off, this thing went down as low as $1. And then again, same kind of thing. I think what happened in this time frame that when it went down as low as $1 to where we are now, it's now up over 181%. And I think obviously there was a lot of panic selling that went on, but I think the realization here was that the market kind of caught on that the coronavirus and the shift to e-commerce was actually going to be a net positive for FlexShopper. That wasn't immediately obvious. There was a lot of, again, panic selling and uncertainty in early 2020. So it's kind of what led to this big sell-off here. But it has since recovered and been on its way. And it's most recently ran up to, over $3.44, as we can see over here. It's in the middle of a pullback most recently. We see that, since that time frame, it's actually down about 21%. But if we look at this trend and we couple that with our knowledge of the valuation that we just walked through, and again, understanding that, again, I can't stress this enough. I'll say it 3, 4, 5 times, but this is high risk, okay? So, this is certainly, to be able to say that you're going to buy in here and assume that this trend is going to continue, high risk. But when we look at our valuation, there's the justification that this actually might be worth north of $4 a share. So for me to be able to buy this at $2.81, I'm happy to own it at this price. And I want to just continue to monitor it, to continue to see how the quarters come in. And if there's any change, if there's, maybe, more delinquencies out there, if there's, the revenue growth slows or turns negative, those are all things that could help me, reevaluate my position in this stock. But in the meantime, I am a shareholder. I actually own 1,200 shares of this, so it's something that I'm going to continue to monitor. If you want to be a part of those updates, you want to see how this thing does, for the next, few months and beyond, subscribe to this channel. Love to have you as a subscriber, and I will see you next video.